This has been the longest bull market in history. Everybody knows it can't last forever. You've studied market cycles, and you've identified patterns in investor behavior at various stages of risk-taking, from indiscriminate buying to sell everything panics. Where are we now?
Well, after 10 or 11 years of economic and market gains, you can't say we're at the beginning. You can't say that we have bargain-priced assets which are languishing. The truth is that, especially with the low interest rates, institutional investors who need significant returns are pursuing risk assets aggressively and alternative assets. They have to. So I think that most assets have been bid up and are selling at prices above their intrinsic values. Most markets are full of capital and somewhat crowded. I don't think we're in a bubble. I don't think conditions are crazy. But I do think that we're in the advanced stages of a very positive cycle.
It's hard to spot a bubble, isn't it?
I don't think it really is terribly hard to spot a bubble. There are certain forms of behavior which characterize bubbles. Now, that doesn't mean it's going to... If you correctly say we're in a bubble today, that doesn't mean it's going to be punctured tomorrow, because things can inflate further. But I think that, I've been doing this now 50 years, and I've lived through some bubbles, and I believe I've seen some bubble behavior. For example, almost every bubble, I guess, is characterized by people saying about a certain asset class or asset, there's no price too high. And I saw it in the Nifty 50 years ago, and I saw it in the techs 20 years ago. For a XYZ, the merits are so strong that there's no price too high. And clearly that's irrational.
Isn't that what's going on today with negative yielding debt?
I don't hear anybody saying there's no price too high, but certainly when people buy bonds at prices that guarantee losses over the holding period, it's debatable whether there's irrational behavior going on. There are...
You really think that's debatable?
Well, there are... I put out a memo, as you know, on that topic a month ago or so, called Mysterious, because I do think it is mysterious. And there are explanations. For example, in a low return environment like today's, where most assets are inflated, as we just discussed, you could argue that a bond in which you only lose 0.5% a year for the next 20 years is the least worst. I don't argue that, but I mean, that's one line of thinking. Some people buy bonds that yield -0.5 because they think interest rates are going down. So a year from now, a bond that has the terrific yield of only -0.5 will be very much in demand. So there are explanations. The only question is whether you buy them.
Who, if anyone, should be a buyer of negative yielding debt? If it's not you.
Sure. Well, the negative yield is a storage fee. So what you're saying is I'm willing to pay the government, most of this is sovereign, I'm willing to pay the government of Germany 0.5% a year to store my money, because I'm afraid that if I like the idea that at the end of every year I still have 99.5 cents left. For certain, because I trust Germany. And I'm afraid that if I do anything else, I'll subject myself to greater losses.
How is it that we can live in a world where, on the very same day, some people, and a not small number of people, are paying the government of Germany or the government of Switzerland however many basis points to store their money, And at the same time, the stock market is trading at a record high.
Well,
sort that out for us.
It's a great question. You know, my mother used to say, "To each his own," said the woman as she kissed the cow. You know, I mean, different people have different opinions. And, you know, well, for one thing, on the debt side, there are people who, A, have to buy debt, don't have the option of buying stocks, and B, in many cases, have to buy their own country's debt, financial institutions, for example. So, you know, they have to, the German institution might have to buy German sovereign debt regardless of the price and doesn't have the option. You know, markets equilibrate when capital has the ability to go back and forth. In some cases, they don't. But, you know, certainly what you're describing is largely irrational.
Irrational markets.
Right.
They've been irrational before.
Yes, yes.
On the subject of bubble-like characteristics,
Yes.
if negative yielding bonds in and of themselves aren't necessarily an indicator of some kind of bubble-like behavior, what about some of the other things that people have observed, particularly in credit markets? Leveraged buyouts being done at 12 times EBITDA and more.
Yeah.
No covenant loans.
Yeah.
The mushrooming of the triple B market. What about that
Buying
stuff?
buying Argentine debt, 100-year bonds. Well, you know,
that doesn't look like such a good trade right
things
now.
can be elevated and imprudent without being bubble. I use the term bubble. You know, the term bubble is used too broadly. You know, some people think that a bubble is any time assets are overpriced. I think a bubble is a special word that should be reserved for special occasions.
True euphoria?
I mean, crazy euphoria, crazy euphoria. A willing suspension of disbelief, and you know, a belief that this asset is so good that regardless of the price I buy it at, I'll make money, and that, you know, that just defies logic. You and I were talking about the logic of markets just before. That defies logic. To say that the price you pay doesn't matter, because regardless of the price you pay, there'll be some greater fool who'll pay you more. Defies logic.
The last cycle, the one that ended in 2008, 2009, was the biggest economic collapse since the Great Depression.
Right.
How do you think this cycle will end? What will it look like?
Well,
what will it feel like?
Well, first of all, the subject of today's conference notwithstanding, I don't consider myself a forecaster, as you know. But, you know, we talk about the fact that this economic expansion is the longest on record. There's never been one of more than 10 years before, and now there is. And, of course, the bull market as well, the longest bull market in history. So, and everybody fixates on that. But the length of the economic expansion notwithstanding, this is the slowest economic expansion on record. You know, if you look at a chart of economic growth over the last 10 economic expansions, and this is zero, they look like this, they're all over the place, and then this one's down here in terms of rate of growth. And so, you know, I believe that one of the reasons we have cycles of up and down is that we have excesses and corrections, and excesses and corrections around the trend line. And I believe that, and of course, an excess is a period when the economy grows much faster than the trend line, and then it reverts to and usually through the trend line. And you know, I don't think in the real economy, I don't think there have been a lot of excesses in this particular cycle or in this recovery. You haven't seen, for example, a lot of factory building ahead of demand and so forth. And so,
what about balance sheet excesses? There's an awful lot of corporate debt.
Well, that's different. I said in the real economy. Now, you're talking about finance. And in finance, there has been. I think that the ultra-low interest rates, the rates of 0 and below, have warped a lot of calculations. And so, of course, in a small picture sense, it makes sense that companies have taken on more debt because it's so cheap. You can borrow money and it costs you almost nothing per year. Why wouldn't you? Well, the answer is that the more debt you have, the less likely you are to get through a period of economic difficulty. But in the meantime, yeah, there's been a lot of levering up at all levels.
Where do you see evidence of warped calculations?
Well, for example, the pension fund that needs a return of 7.5 and can't use cash, money markets, high grades, or even get what it thinks it needs from stocks and bonds, pushes out to alternative investments. Private debt, private equity, venture capital, and things like that.
It's been great for Oaktree and for Brookfield.
And for our peers. That's right. When we started Oaktree, we left the firm, my colleagues and I left the firm where we were managing $7 billion, and our hope was we would get back to $7 billion. And as you said, now we're at 120. So that gives you an idea. By the way, of course, when we started Oaktree, the word alternative investment didn't exist. And now it's extremely important. But I think, so that's an area of excess. The capital has flowed to the alternative markets. You've heard me before describe the people doing it as handcuffed volunteers. They're doing something because they think they have to.
Do you worry, Howard, because of the fact that we have negative interest rates, for example, because we've had and still have quantitative easing, that the old rules of the game don't apply any longer? And if they don't, what do you do? Well,
that's really one of the very most important questions. I wrote a memo 2 months ago called "This Time It's Different," and historically, the words "this time it's different" have been used by people to rationalize bullishness that didn't work out in the past and violations of the norms that prevailed in the past, like valuations and that kind of thing. But John Templeton said, 20% of the time it really is different. And nowadays you have the sense that it's going to be more than 20%. So I think things, you can't say that the old rules apply, and you can't say that in the absence of the old rules, you know exactly how this is going to come out. We are in a difficult period.
Everyone should be looking for red flags. Certainly anyone who has money at risk in the market.
Yeah.
Eventually, the prudent investor will stop putting money to work, and he or she will wait for prices to correct. What signals, or red flags, if you will, Howard, are you looking for to know that that moment has arrived? What should we see?
There are no. You have to watch all these trends, and in particular, you have to watch what I call pro-risk behavior. People who are putting assets into risky asset classes because they feel they have to.
We just established that that's happening all over the place.
And that's what I was going to say. So if that's the warning sign, then
we're already there.
Then we're already there. So that can't be the warning sign, or that warning sign can be exceeded, which is really true. And the answer is, you can't say it's time to get out. What you have to say is today, given the totality of everything we've been discussing and all the on one hand and on the other hand stuff, should you have more risk than usual or less for you? I hope that every investor has a sense for what his or her normal risk posture should be. And the question is, today, should you have more risk or less risk? And I would say less. And that's different from saying it's time to get out, it's time to sell. But I do think...
We're not there yet in your mind.
Well, I don't know if we ever know that we're there. This is the time to sell. Anybody who says it is probably talking through his hat and unlikely to be right. But I do think that I feel very comfortable in saying that this is a time to have less risk than normal in your portfolio for the reasons we discussed, and in particular that this is not a time to be aggressive.
Howard, President Trump is a self-styled fan of low rates.
Yes.
He says the Fed should cut rates further. Why? Because there's no inflation, and furthermore, European rates, as we've established several times in this conversation, are negative.
Yes.
As a result, he says Germany has an unfair advantage. The U.S. dollar is too strong, and that's hurting exports. Why shouldn't the Fed keep cutting rates?
Well, number one, the proper rate has something to do with the rate of economic growth. And our economic growth is better than the rest of the world. So we should have higher interest rates than the rest of the world. Number two, in that memo, Mysterious, I think I listed a dozen possible negative effects of having rates too low, including the fact that I think it sends a very negative message to people. And so in Europe, for example, where they have negative rates, and you don't get anything on your savings, they have a very much above average savings rate, I think, because people are afraid. And one of the reasons they're afraid is that the central banks are telling them things are really rough out there, and that's why we've put the rate at negative. And then the other thing is, of course, that you want to have firepower as a central bank so that you can lower rates if the economy slows. Our economy is growing, and this is not a time to stimulate the economy, in my opinion. I don't think it's the Fed's job to prevent recessions and keep the market going up, in my opinion. But if it's true that you want to have firepower so that you can cut rates if things slow, then how much lower can you go than 1.5? It's really an interesting question if you think about it. Historically, for example, in the global financial crisis, they cut rates from 5 to 0. And most stimulus programs are 5, 6, 7%. If we're at 2%, can you cut rates 5?
Only if you go negative.
Well, and there are some people who will say you can. But if you look at Europe and Japan, it's hard to argue it's working. They have negative rates and not a lot of economic vigor.
The people sitting in your seat this morning, Howard, have been asked what the biggest challenge is in the year ahead. Is politics the biggest challenge in the year ahead?
Well, for investors, politics is one of the things that contributes to I don't think it's the biggest challenge. The biggest challenge is deciding how you get a decent return in a low return world without taking an inordinate risk.
Okay, what about the biggest risk then?
Well, the biggest risk is that you and others are taking excessive risk because you feel you have to.
Herd behavior.
Herd behavior, yes. And, what could cause the herd to change its mind? Hard to say. We had last year at this time, we had one of the worst fourth quarters and one of the worst Decembers in history. Hard to say exactly why. The herd is subject to turning. In 2000, the TMT bubble burst. If you go back and watch the videotape from 2000, it's hard to find a reason. It just did. Maybe prices were unsupportably high. Maybe people who were very bullish for some reason changed their mind en masse. I don't think we can predict what's going to cause the next correction, but I believe we will have one.
But the key is to watch the herd and to be careful?
No, I don't think so. I was on your show February 16, and you and your co-host were saying, well, the market's going down, down, down. Isn't that a sell signal? I don't think the market knows anything. I ran back from your show to my office and wrote a memo entitled, What Does the Market Know? And I don't think the market knows anything. I think we can't take our instructions from the market. The market is not smarter than us. But we have to, I mean, you could watch for increases in unemployment. That would be a very negative sign. And you should watch for reductions of earnings expectations. Those two things together would give you pause. But, there are a lot of people who believe that as long as the Fed supports, the market will go up. And they could be right. So, the investment markets are not something like physics where you know, there's a schematic that always works, and we don't know how this thing's going to work. The only thing we can know at any given point in time, in my opinion, is whether we should have more risk than usual or less.